Mortgage rates moved higher again on Wednesday, August 12th, keeping borrowing costs near some of their highest levels of the year. The average 30-year fixed mortgage rate reached 6.65%, while the average 15-year fixed rate rose to 6.00%. For home buyers, that means affordability remains a major challenge. But the headline rate isn't the whole story. The rate you actually receive can depend on your credit score, down payment, debt-to-income ratio, loan type, property, and lender. So let's look at what today's market really means. The 30-year fixed mortgage remains the most popular option because it provides predictable payments and spreads repayment over 3 decades. The advantage is a lower monthly payment. The trade-off is that borrowers generally pay significantly more interest over the life of the loan. The 15-year mortgage offers a different strategy. With rates around 6%, homeowners can build equity faster and potentially save a substantial amount in total interest. But the monthly payment is much higher, so it may not be the right choice for every household. Adjustable rate mortgages are another option. A 5/1 ARM, for example, typically keeps its initial rate fixed for 5 years before adjusting. That can work for buyers who expect to move or refinance before the adjustment period begins. But there is a risk. If rates are higher later, monthly payments could increase. For homeowners considering refinancing, today's market requires even more careful analysis. The average 30-year refinance rate was around 6.73%, slightly above the purchase rate. If your existing mortgage has a significantly lower rate, refinancing simply to reduce the payment may not make financial sense. Closing costs matter. Before refinancing, calculate your break-even point and determine how long you expect to keep the property and the new loan. For buyers, higher rates are also changing the housing market. A rate near 6.65% reduces purchasing power, which can push buyers toward lower-priced homes, larger down payments, or stronger negotiations with sellers. But there is a potential advantage. Higher financing costs have reduced competition in many markets, giving financially prepared buyers more time to inspect properties and negotiate price or concessions. The key is not trying to predict the perfect mortgage rate. Instead, focus on whether the payment fits comfortably within your budget today. Improve your credit, manage your debt, compare multiple loan offers, and look at the total cost, not just the advertised interest rate. 2 lenders can offer similar rates but very different fees and closing costs. Looking ahead, mortgage rates will remain sensitive to inflation, employment data, treasury yields, and Federal Reserve expectations. If inflation continues to cool, borrowing costs could eventually become more stable. If inflation remains elevated, rates may stay higher for longer. The bottom line, 6.65% is challenging, but the right mortgage decision depends on your complete financial picture. Whether you're buying or refinancing, comparing your options carefully can make a meaningful difference over the life of the loan. Contact US today for a real tailored consultation where our expert advice turns potential into profitable reality. The content has been reviewed before publication and is provided for educational and informational purposes only.